In the last few videos, we've talked about building a portfolio using three main building blocks: US stocks, international stocks, and bonds. But then you open your brokerage account and search for a US stock ETF, and suddenly you find dozens of options: VTI, VOO, ITOT, SCHB, SPY. They all seem to invest in American companies, so which one should you choose? The good news is that choosing an ETF doesn't have to be complicated. Today I'll show you a simple framework that professional investors use to compare ETFs, so that instead of guessing, you'll know exactly what to look for. One of the first things that surprises new investors is that many ETFs perform essentially the same job. For example, if your goal is broad exposure to the US stock market, several different ETFs can achieve that objective. Some track the entire US market, others follow only the largest companies, others focus on specific sectors. At first glance, this can feel overwhelming, but remember something we've already discussed throughout this series. An ETF is simply a vehicle. The important question is not the name of the ETF. The important question is, what does it actually own? The first thing to check is the index. An ETF doesn't randomly choose companies. Instead, it follows a predefined index. For example, VTI follows the CRSP US Total Market Index. VOO follows the S&P 500 Index. Although both invest in US companies, they represent different portions of the market. One includes nearly the entire US market. The other focuses on approximately the 500 largest companies. Neither is inherently better. They simply represent different investment strategies. Whenever you evaluate an ETF, always begin by asking, which index does it track? The second criterion is one we've already mentioned several times throughout this series: the expense ratio. This is the annual fee charged by the fund manager. Many excellent index ETFs charge only around 0.03% to 0.05% per year. That may sound insignificant, but investing is a long-term process. Even seemingly small differences in annual fees compound over decades. One of the few things every investor can control is how much they pay to invest. Lower costs don't guarantee higher returns, but keeping costs low means more of your money stays invested and continues compounding over time. Evidence Corner, Morningstar. Morningstar has repeatedly found that expense ratio is one of the strongest predictors of future fund success. Their research shows that lower cost funds have historically been more likely to outperform higher cost alternatives after fees. While no investment is guaranteed to outperform, keeping investment costs low is one of the simplest and most reliable decisions an investor can make. Next, look at diversification. Ask yourself, how many companies does this ETF own? Some funds own several thousand companies. Others hold only a few dozen. Generally speaking, broader diversification reduces the impact of problems affecting any single company. If one company performs poorly, thousands of others continue contributing to the portfolio. Diversification cannot eliminate market risk, but it helps reduce the risk associated with individual companies or sectors. The fourth criterion is fund size. Large, well-established ETFs generally have more assets under management, higher daily trading volume, and tighter bid-ask spreads. For long-term investors, this usually means lower trading costs and greater liquidity. Again, this isn't usually the deciding factor between two otherwise similar ETFs, but it is worth checking. At this point, you may be wondering, if broad market ETFs already exist, why are there hundreds of different ETFs? The answer is that ETFs can focus on different parts of the market. Some invest in the entire US market. Others focus only on large companies. Some emphasize companies expected to grow rapidly. Others focus on companies paying dividends. Some invest in technology. Others specialize in small companies, real estate, or emerging markets. These are all legitimate investment strategies. For most beginners, however, broad market index funds provide an excellent starting point. As your knowledge grows, you'll be able to decide whether any of these specialized ETFs fit your investment objectives. If you'd like to compare ETFs in more detail, websites such as Portfolio Visualizer allow you to compare funds using decades of historical data. You'll see dozens of statistics. Don't worry if many of them seem unfamiliar. At this stage, I'd recommend paying attention to only 4 things: historical annual return, volatility, maximum drawdown, expense ratio. We'll explain many of the other metrics, such as beta, alpha, and the Sharpe ratio, in future videos as we continue building your investing toolkit. Remember, the purpose isn't to find the perfect ETF. The purpose is to understand how to compare them objectively. Conclusion and assignment. Let's summarize the framework. Before choosing an ETF, ask yourself 5 simple questions. 1. Which index does it track? 2. Is the expense ratio low? 3. Is it broadly diversified? 4. Is it a large established fund? 5. Does it fit the role I want it to play in my portfolio? Your assignment before the next video is to choose one US stock ETF, one international stock ETF, and one bond ETF available through your brokerage or retirement account. Look up the index each one tracks, its expense ratio, approximately how many holdings it contains, and, if you're curious, compare them using Portfolio Visualizer. Don't worry if you don't understand every statistic yet. We're building your investing knowledge one step at a time. Remember, understand the foundations, build a simple structure, let time do the heavy lifting. Thank you for watching, and I'll see you in the next video.